Click the bell icon to get latest videos from Ekeeda.
Hello friends, myself Professor Uday Bhukre and now I am welcoming you on your own YouTube channel Ekeeda. Friends, if you are watching my video for first time, I request you to subscribe to our channel Ekeeda and also press bell icon for your latest notifications. Today we are going to learn for CA Inter course Advanced Accounting, topic name Amalgamation of Companies, question number 4 which is on your screen. Trade payable का breakup is also available. Fixed assets of both the companies are to be revalued at 15% above the book value. At the time of takeover, they are appreciated. That is, agreed value is 15% above the book value. Inventory in trade and debtors are taken over at 5% lesser than their book values. So, agreed values of debtors and inventory in trade are given. Both the companies are to pay 10% equity dividend, preferred dividend having been already paid. So importantly, it is an additional transaction. Besides whatever normal transactions you get, it is an additional transaction you need to be considered. After the above transactions are given effect to, P Limited will absorb Q Limited on the following terms. That means this revaluation will take place before its takeover. So students, we can say this revaluation will take place before takeover. Otherwise, we would have assumed that these are taken over at a revised value. So revaluation will take place before takeover. After the above transactions are given effect to, P Limited will absorb Q Limited. Means I can say Q Limited is your selling company and P Limited is of course your purchasing company. On the following terms, 8 equity shares of 10 each will be issued by P Limited at par against 6 shares of Q Limited. So for equity shareholders, they will be given equity shares. 10% preference shareholders of Q Limited will be paid at 10% discount by issue of 10% preference shares of ₹100 each at par in P Limited. So it is a basically PC. Point number 1, point number 2 is relating to purchase consideration. 12% debenture holders of Q Limited are to be paid at 8% premium. That means they are taken over at 8% premium by 12% debentures in P Limited. So we need to work out takeover value of the debentures issued at discount of 10%. Let us repeat. 12% debenture holders of Q Limited are to be paid at 8% premium. So debentures of Q Limited will be revalued at the time of takeover by 12% debentures in P Limited. That means how they will be settled by issuing our own debentures which are issued at a discount of 10%. Next, fourth, ₹30,000 to be paid by P Limited to Q Limited for a liquidation expenses. So liquidation expenses are to be paid. Sundry creditors of Q Limited include 10,000 due to P Limited. So there is an intercompany owings which will be cancelled after a takeover. Let us pass the entries, what they are saying. Journal entries in the books of P Limited and statement of consideration payable by P Limited. First and foremost, we will prefer to calculate PC, that is purchase consideration, to be settled. Let us do that working note. Friends, I am ready with the working. Now I have to start with my working. Format is here. Let us start with information number 1 says that 8 equity shares of 10 each will be issued by P Limited at par against 6 shares of Q Limited. They are talking about equity shares. So it is a discharge to the equity shareholders. So that will be a part of PC. Friends, for equity shareholders, what you will get? Equity shares in P Limited. Look here students, 8 equity shares of 10 each will be issued by P Limited at par against 6 shares of Q Limited. That means if you are holding 6 shares, you will get 8 shares. So I can say against old 6 shares, you will get new 8 shares. So let us work out that. Friends, for old equity shares of Q6 shares, you will get new equity shares in P Limited. Let us find out how many equity shares are there in the balance sheet of Q Limited. In the balance sheet of Q Limited, you can notice the share capital is 3 lakhs. Considering 10 rupees, there are 30,000 shares. There are 30,000 shares. Based on that, they will get the shares. So friends, you will get for 6 shares new equity shares. So considering 30,000 shares held by you, you will get new 40,000 equity shares in P Limited. Friends, as a part of PC, you will get equity shares in P Limited, 40,000 equity shares in P Limited of rupees 10 each at par, which comes to 4 lakhs. It is what you will get for your equity shareholder. Let us see the next information to decide how much consideration we will get for our preference shareholder. 10% preference shareholders of Q Limited will be paid at 10% discount by issue of 10% preference shares of rupees 100 each at par in P Limited. That is, preference shareholders of Q Limited will be settled at 10% discount. That means we will pay them 90% only. And how we will pay them? By issue of 10% preference shares of 100 each at par in P Limited. So firstly, I need to decide how much amount I need to pay them. Let us see the balance sheet of Q Limited. Balance sheet of Q Limited consists of 1 lakh rupees preference share capital. 10% less than that comes to 90,000. That means amount to be settled is 90,000. And fresh shares of rupees 100 will be issued. So 90,000 upon 100 comes to 900 shares. So that we need to plot on the paper. Friends, you can notice we are paying for preference shareholders. What they will get? Preference shares in P Limited. Amount to be settled will be 1 lakh rupees ka capital minus 10% discount, that is rupees 90,000. Number of new preference shares to be issued will be 90,000 divided by 100 rupees new preference share ka face value. So I can say 900 10% preference shares in P Limited of rupees 100 each at par will be issued. Right, so that comes to 90,000 and our PC will be total to 4,90,000. Friends, our PC is 4,90,000. This is what the requirement of the question. It is actually second requirement, but we need to compute it first because our entries will be based on this. Let us see further. Friends, I am ready with my journal. Now we have to pass entries for the transactions which took place before you did the amalgamation, before you do the absorption. So let us see the question first. Fixed assets of both the companies are to be revalued at 15% above the book value. So fixed asset will be revalued. So I will consider that. Look at the balance sheet of P Limited. They have a fixed assets of 7 lakh. Those will be revalued. They will be revalued at 15% upward. Friends, you can notice the entry fixed asset account debit to revaluation reserve account 7 lakh ka 15% is increased, being fixed assets revalued. These are the revaluation of our own assets. Q Limited will carry its own revaluation for which we are not recording an entry. Next, what they are saying, inventory in trade and debtors are taken over at 5% less than their book values. They are taken over, means we are taking over from Q Limited at this value. So it is the agreed value of the asset taken over. Please note that it is not a revaluation of our own assets. We have revalued only our fixed assets. Both the companies are to pay 10% equity dividend. preference dividend having been already paid. So they are saying that both companies will pay their equity dividend at the rate of 10%. So let us pass the entry. Firstly, to declare the equity dividend and then to pay. Friends, for declaration of dividend, I will use reserves and surplus which are there in my books. It is 3 lakhs available. So I will say reserves and surplus account debit to equity dividend account or to declared equity dividend account, and then it will be paid. Friends, equity capital in the balance sheet of P Limited is 6 lakhs. 10% of that comes to 60,000. Friends, it is how we have calculated our purchase consideration. Now, question is asking you journal entries in the books of P Limited. So we have to make a format of journal in the books of P Limited. So let us draw the format. Friends, I am ready with the format and now we have to draw all journal entries. Before I begin with your amalgamation or takeover entries, I need to pass the entries for the additional transactions which they gave you. Let us see those transactions. Friends, you can notice fixed assets of both the companies are to be revalued at 15% above the book value. So whatever are your existing book values, that will be appreciated by 15%. It is a transaction before your takeover, right? So what will be our entry, sir? For us, P Limited will revalue their own fixed assets. Your entry will be fixed asset account debit to revaluation reserve account. It is merely a revaluation of the asset, nothing more than that. So let us pass that entry. We have revalued fixed assets of P Limited. Entries fixed asset account debit to revaluation reserve. Existing cost of fixed assets of P Limited is 7 lakh, which is appreciated by 15%, 1 lakh 5,000, being fixed assets revalued. Let us see what other transaction they gave you. Inventory in trade and debtors are to be taken over at 5% lesser than the book value. So it is a entry relating to the takeover. It will not come here before our takeover entries, other entries we are taking up. Both the companies are to pay 10% equity dividend, preferred dividend having been already paid. So your company is going to pay equity dividend at the rate of 10%. For that purpose, we will use our reserves. Your entry will be reserve surplus account debit to equity dividend declared account, or I can say declared equity dividend account. And when you pay equity dividend declared account debit to cash or bank, that is bank account, that second entry will be recorded. So two entries will come back to back. Let us pass those entries. Friends, you can notice equity dividend is payable out of reserve surplus. They have not given which reserves are available. So I am just saying reserve surplus account debit to equity dividend declared account. And here I am debiting equity dividend declared or payable. Payable is nothing but declared. Debit to bank account. So in this way we have completed payment entry also. Two entries are recorded before your absorption, before your takeover. Now these are the two transactions which took place before your takeover. Thereafter, now we will begin with our normal entries for acquisition of the business from that Q Limited. Let us record those entries. Our next entry for purchase of business, your entry will be business purchase account debit to liquidator of Q Limited account. This entry will be recorded at PC price, which is decided by you in our working note. Friends, have a look at this calculation. Your PC is 4,90,000, so your business purchase entry will be recorded at this amount, 4,90,000. So finally our entry is business purchase account debit to liquidity of Q Limited. Amount is 4,90,000. So narration I need to write being business purchase recorded. Friends, next entry is for acquisition of the assets and liabilities from that Q Limited, for which I will record the next entry. For takeover of all assets, I will debit assets account. I will credit all liabilities which are taken over. That will take care of our net asset, and I will credit business purchase account, so that this business purchase account which is there, that will be getting closed. The difference in the entry we will record as a goodwill or capital reserve. Let us note down that entry. Here I have debited the assets taken over and I have created liabilities taken over. Importantly, in the bracket you can notice their aggregate values which are as per the question, which I will make you understand. Fixed assets account we have debited at 15% more. You can understand that earlier they have revalued their assets, earlier they have revalued their fixed asset at 15% more, right? So let me show you. In the balance sheet of Q Limited, fixed assets were 2,50,000. They are appreciated by 15%. In that way, takeover value is 287,500. Next, inventories. For that, they are mentioning 5% less. Let me show you that line. Inventory in trade and debtors are taken over at 5% lesser than their book values. So I have noted that. Inventories book value 320 minus 5%. Trade receivable debtors 1,90,000 was there. From that I have subtracted 5%. Sir, where is that 1,90,000? Let me show you. This 1,90,000 is reduced by 5% for the purpose of takeover. Besides that, existing bills receivable taken over, which is a part of trade receivable, that is also debited. Investment taken over are also debited. There is no revaluation of investment, 80,000. Bank account is debited. Remaining bank account, importantly, they were having existing bank balance of 40,000. You can notice, students, they were having existing bank balance of 40,000. On that, rather out of that, they paid equity dividend on their capital of 3 lakhs at the rate of 10%. That comes to 30,000. So from 40,000, they already paid 30,000. So how much bank balance we can take over is only 10,000. Friends, notice here, 40,000 minus 30,000, we have taken over 10,000. In this way, we have completed assets taken over. At the time of liabilities takeover, also I have credited as per their aggregate values. Let us check. Trade payable creditors, there is no revaluation. Trade payable bills payable, there is no revaluation. I have taken everything at a book value, which is given in the example. Here are the details of trade payable of Q Limited, which are taken over as it is. 12% debentures are to be discharged at 8% premium. So based on that, your debentures having a book value of 1,50,000, it is taken over at a premium of 8%. Let me show you those lines. Information number 3 says that 12% debenture holders of Q Limited are to be paid at 8% premium. So it is your takeover value, 8% premium. What are the debentures in the balance sheet of Q Limited? In the balance sheet of Q Limited, we are having debentures of rupees 1,50,000, which is added with a premium which is 8%. So here how I have recorded assets taken over and liabilities taken over. Cannot I say I have recorded here net asset taken over? It is worth what I am getting from that company, and for that how much amount I agreed to pay as a business purchase as a PC, we have agreed to pay 4,90,000, which will be credited. Can I say after I have written here business purchase, your net asset automatically get compared with the net payment, and the difference, if it is on debit side, it is your goodwill. If it is on credit side, it is your capital reserve. Let me check out what is your debit side total and what is your credit side total. Your debit side total is 8,82,000, while your credit side total is 8,02,000. So there is a difference on credit side which is 80,000, that will be considered as a capital reserve. So I will credit capital reserve account as a difference amount. So this difference I have credited to the capital reserve, 80,000. This will appear in our balance sheet as your reserve surplus. I need to write down the narration being assets and liabilities taken over, and difference is agreed as a capital reserve. Friends, our narration is being assets and liabilities taken over at agreed values. Difference in PC and net asset is credited to the capital reserve. In this way, we have recorded the entry for takeover of the assets and liabilities at agreed value. Friends, our next entry will come for discharge of PC. You can notice our entry liquidator of Q limited account debit to equity share capital account and to preference share capital account. Sir, all these calculations I have taken from my PC calculation. Let me show you that. We have issued 40,000 equity shares of 10 each for the settlement of equity shareholder, and we have issued 900 preference shares of rupees 100 each for the settlement of your preference shareholder. Right? So in this way I have recorded PC discharge. After this we will pass additional entries. Sir, for what? These debentures are settled by giving away new debentures. For that I will pass the entry, and thereafter we will see what next entry can be there. Notice your information number 3 here. They are saying 12% debenture holders of Q Limited are to be paid at a 8% premium. First, this part which I have made a bracket, this part is the agreed value of their debentures. They are discharged by what? 12% debentures in P Limited issued at a 10% discount. So we are settling their old debentures by giving them new debentures. So I need to pass the entry old debentures account debit. Discount on new debentures will be debited to new debentures account. So I am recording the entry and then we will discuss about it. I have debited 12% debentures account 162,000, and I know that we are issuing our own debenture at a discount of 10%. So I know discount on issue of debenture account should be debited to 12% debentures account which are new. How we decided the amount? We have issued our debentures of 100 each at a discount of 10. That means for them, for their old debenture holder, its worth is 90. So 90 represent 162,000. So what will be a 10? Simple cross multiplication give me 18,000, and the face value of the new debentures which are issued to them comes to 1,80,000. In this way I have discharged their old debentures by issuing my new debentures at 10% discount. I just hope entry is clear. Let us see the next thing. Fourth information says that rupees 30,000 be paid by P Limited to Q Limited for liquidation expenses. It is an additional cost incurred for acquiring the business. It is a loss to you, but you can understand that at the time of takeover of assets and liabilities, there were capital reserve. So this loss will be taken care by your capital reserve first, and if it is overspent amount, then I will say goodwill account. Let me check what is my capital reserve at moment. Friends, you can notice our capital reserve is 80,000. With the help of that, I am settling this 30,000 as the expenses. So 30,000 expenses I will debit to the capital reserve and I will credit to the bank account. Let us pass the entry. Friends, my entry is capital reserve account debit to bank for the liquidation expenses paid for Q Limited. Let us see what is additional information. Rupees 30,000 is to be paid by P Limited to Q Limited for the liquidation expenses, for which we already recorded the transaction. Sundry creditors of Q Limited include 10,000 due to P Limited. So it is the intercompany dues which is cancelled. So I will say creditors account debit to debtors. I will say trade payable account debit to trade receivable. To the extent of creditors and debtors, that amount will get adjusted to the extent of 10,000. So let us record that. In this way, I have recorded the entry trade payable account debit to trade receivable. Trade payable, I am speaking about creditors, and trade receivable I am talking about debtors. So these are mutually getting cancelled. So in my balance sheet, this amount will get adjusted. Question have ended their requirements. They have asked you only journal entries and they have asked you only business purchase calculation, that is PC calculation. You can look at the requirement, journal entries and PC calculation. They are not asking you a balance sheet. If they ask you a balance sheet, you can prepare that balance sheet. But in this question, it is not needed because it is only the requirement. It is only the question. I think very easy question, very short question. In exam, this question can appear for 7 to 8 marks. So students, this question you can go through before your exam. I am sure you must have understood whatever we have solved here. But still, if you have any doubts, if you have any queries, please put in the comment box and we'll try to resolve your queries at earliest. Thank you for watching the video, and before I close the video, I request you to share this video with your friends so that they can also get benefit from this. Thank you students. God bless you all.